You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everyone. Welcome back to the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down how you, as a busy financial advisor or perhaps an asset manager, or indeed even the potential client of a financial advisor, may think about using options and incorporating them into your portfolios, as well as all the happenings and goings on in the world of options that pertain to the financial advisors and the asset managers out there. My name is Mark Longo from the optionsinsider.com, as well as from the ever-exciting Options Insider Radio Network. 13 programs on said network now, including all of the archived episodes of the Advisor's Option. Where can you find all of those programs? Well, you can surf on over to the mothership, the flagship, if you will, theoptionsinsider.com. Click on the Insider Radio Network tab at the top of the page, and that will bring up an overlay that has all of those programs there for you. Just click on the View Archives, and you could check out any program that you're interested in. Or, of course, you can find us on iTunes, Stitcher, Aha Mobile, all of the major audio platforms were there as well. So we encourage you, check out the archives. If maybe you're joining us for the first time here in the new year in 2015, or perhaps you missed an episode, you want to go back and refresh yourself on it, check out the archives. A lot of great stuff in there for you guys to pick through. All right, and joining me on the old program today, my usual compatriot, my financial advisor, partner in crime, good old Randy Swan, the co-founder of Swan Global Investments. Randy, welcome back to the program, sir.
Great. It's good to be back. I just noticed that there's a 45-degree temperature difference between Puerto Rico and Chicago right now. So I'm happy I'm on this side of it.
So you had to rub that in, didn't you? A little bit of a temperature gradient, you could say, just a wee bit. But it actually is unseasonably warm here. We're close to the 40s or so we can't really complain here on the Chicago side. We don't have the lush tropical foliage of you guys down there in Puerto Rico this time of year. But hey, we'll take what we can get. At least it's not snowy and minus 35. So we'll take what we can get. And also joining us on the program today, at least for our opening segment, we have, you know him, you love him, from the Option Block, making a guest appearance here, on the old advisors option. He is Mike Tusaw from RCM Wealth Advisors, RCM Asset Management. Mr. Mike Tusaw, welcome to the advisors option, sir.
Always good to be here, and always good to know that I'm not the partner in crime. I am innocent.
Yes, you are indeed innocent when it comes to this program. All right, with the innocence established and the team assembled, let's dive right into our first segment and get into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, that theme music means it's time to dive into the buzz. This is the portion of the show where we break down some interesting developments, some highlights, some research, some new studies, all the cool things that are going on in the world of options that really pertain specifically to this advisor and asset management audience that you may not be aware of. You know, you guys are busy, you're out there handling clients, getting new AUM, doing a lot of the other things you have to do as a very busy, very active advisor. You maybe don't have time to keep up on the latest developments in an area of the industry that maybe you're not that familiar with. So we do it for you here. And kicking things off on the buzz today, there's just came out with a very large study, the first of its kind, really, I thought was really important to parse here on the program. This was essentially a new white paper put together by our friends over there at the CBOE, the Chicago Board Options Exchange. It's one of the first really large scale examinations of the use of options, specifically when it comes to portfolio management, which is, of course, a topic that we discuss here quite a bit. And they did a lot of interesting things with this study. This is also for the first time that I'm aware of, and they kind of cite this in the study as well, the first time anyone's really gone through and evaluated the fund universe out there and kind of parsed out and filtered out the options-related type funds, including the SWAN Defined Risk Fund, which is included in this study. And they analyzed all of these funds. I believe it came out to right about 120, 119 total funds over a 15-year period from 2000 to the end of 2014. And they pretty much took that 119 and they filtered out ones that don't primarily focus on the major stock indices. So they filtered out some of the commodity ones and other ones like that. And that left them with about 80 or so funds that they were able to analyze. And there were a number of interesting takeaways. We'll get into some of these and we'll kind of get some good discussion going on this topic. But just overall, the landscape, and Randy, I'm sure you're aware of this as well because you're included in this number. The study found that the number of options-based funds grew from only 10, just 10 in the year 2000. So just 15 years ago, there were only 10 options-based, options-oriented, whatever you want to call them, funds out there, now to a total of 119 in 2014, which is a pretty impressive growth rate in and of itself. Randy, I'm sure you've had a little bit of time to parse this study because you guys are included in it. I'm assuming that massive growth rate doesn't come as a surprise to you since you guys are one of that 119 and are soon to have many more in that list.
Absolutely. I mean, the absolute number it's a great show of growth in this industry. We love the space to grow even more. I mean, obviously, saying that every strategy that has an option strategy is a very diverse group, so it's not necessarily all the same types of strategies that are being employed. But no, I'm generally excited about it. It goes back to the same movement that we've just since we've been doing this show over the last 3 or 4 years, talking about how more advisors, more individuals are willing to see the benefits of options-based strategies and see that they fit in their portfolios. So we're pretty excited about it.
Yeah, that's a good point. You know, it is kind of a diverse group to aggregate all of these options-oriented funds together because they're not really all come from the same mold. You have put writing strategies, you have covered call strategies. Those are very similar, of course. Then you get into other things that are more hedging oriented and different types of strategies that have different outlooks. And so kind of lumping them all together, we'll get this in a little bit, maybe a bit of a mishmash, but overall, it still is interesting to look at them from a pure 10,000 foot perspective and see what kind of numbers the industry actually generated. And let's get into that a little bit because it was kind of interesting. First off, you know, the notion I think a lot of people have is that these options oriented things are primarily oriented towards hedging, also income, but hedging is a primary concern. So they're going to underperform from a total return perspective. And what this study found, when you looked at all, I believe it was 80 some, I'll have to look at the exact number of the ones that were focused, of that 119 that were focused on the equities, I believe it was 84, something along those lines. Of those funds, when they averaged them out over 15 years and compared them to the S&P over that 15-year period had an annual return rate of 4.2%, and the options-based funds had exactly the same, 4.2%. So overall, first off, the nice thing about it is that you're not going to underperform from a total return perspective. You're actually going to be neck and neck there with the S&P, which I think a lot of people at the end of the day are very concerned about total return, obviously, and the options funds performed well there. Now, of course, once you start diving into the metrics a little bit, the performance becomes even more impressive because you start looking at things that are important to the asset managers out there, to the financial advisors out there, as well as to their clients. It's really about not just total returns, but the return for a unit of risk. They want to know how much risk their advisor is taking in their portfolio and how much they're being compensated for that. And when you look at it on a risk-adjusted basis, the options-based funds really blew the doors off of the broad index as well as all the other strategies outlined in this study. And they outlined a bunch. I encourage you to check out the study for yourself, listeners. You can search for it on the CBOA website. We have a link to it. It's called The Highlights of Performance Analysis of Options-Based Equity Mutual Funds, CEFs, and ETFs. They break down a lot of different asset classes in there. We're just going to focus on the S&P 500 for here. But they looking at the risk metrics, of course, the overall annualized standard deviation of the options fund, which is kind of the broadest risk measure out there, was 11.1%. That compares to 15.3% for the S&P 500. So that alone, in and of itself, was a substantial reduction in risk. And that is, of course, attributable to all the strategies we talked about on this show in the past that really utilize volatility to minimize the overall volatility of your portfolio, as well as minimize the drawdowns and things like that. Speaking of max drawdowns, another good measure of risk in these portfolios, the options-based funds had a maximum drawdown of 42.2% for the options-based funds versus nearly 51%, 50.9% for the broad S&P 500. And again, going back to Randy's points, this is an aggregate for all the funds. I'm assuming if you parse those funds a little bit more and look at the ones that are kind of analogous to what Randy and the guys at Swan over there are doing, they're doing overlays as opposed to just, let's say, just blasting out puts, because I don't know what all these options-based funds are doing. I'm sure if you looked at them, the funds that focus on hedging, then that maximum drawdown would probably be substantially lower. But still, overall, options-based funds still outperforming from a max drawdown perspective. And some of the other ratios, Sharpe ratio was a 0.27 for the options-based funds versus 0.23 for the S&P 500, and Sortino, another widely used measure of risk to return, risk to reward, 0.23 for the options-based funds versus 0.20 for the S&P 500. A couple other fun facts that were sorted in there. The overall options-based funds, their worst year, as you might imagine, was 2008, pretty much everyone's worst year. The options-based funds only lost 29.1% in 2008 versus 37% for the S&P 500. And the best year overall, 32.5% gain in 2009 versus the 26.5% gain for the S&P 500. So overall, the funds did perform very well. Mr. Uncle Mike Tusaw, glad to have you here on the program. A lot of fun stuff here to parse. I know you probably have had a little bit of time to look at this study as well. It just came out very recently, so it's still very new. But what's your takeaway from this overall analysis of the world of options and funds?
Well, I'm actually surprised that we still don't have more funds in the category than we do, to tell you the truth. I would think just with all the popularity of the risk-based annuities out there and with the search for income in the world, if you say the word income, if you talk to a client, just say the word income, it seems like you have their attention. Even if you can say income and then talk about pajama parties, you'll still have their attention because you said the word income in there. So I'm actually surprised that there's not more option-based funds out there. The other thing that I think is interesting about this, and this is something maybe for you advisors out there, most people that can look at a fund and understand it the right way that they should probably trade options anyway. Because if you're trying to compare a collar strategy to the S&P, for those of us that understand options, it's really not a fair comparison based upon risk. However, if you have an understanding of what a collar strategy is, why you would use it, when you would use it, most people probably trade anyway. As an advisor, I think this is if you're not one who trades but is looking to have some type of option exposure, whether it is covered calls, short puts, collars, whatever you're looking to do, I think there's a lot of opportunity here for you as an advisor if you have a decent understanding of how these work. You can then go to a client and tell them that this is what your potential reward is, this is what your potential risk is, this is how this fund is based. You can explain to them how the fund works, why it works, and it can really be a great tool in terms of diversification. I think that the other thing to do is make sure that you do have an understanding of options, at least somewhat, before messing with a fund like this, because if you don't and the client asks you about it, then you're probably not going to look too good. So that's why we're all here. I think it's an exciting day.
Yeah, it's not often we get the hard numbers in this space to really parse on a regular basis. That's why I like having the OIC guys as a part of this show, because they usually bring a lot of fun data to the space with their annual or semi-annual Bellamy studies that they work out here. And now we have the SIBO jumping into the fray with this study as well. Randy, like I said, I'm sure this study is near and dear to your heart, not just because it's new data, but also because of the fact that you guys are actually included in there. I'd be curious, in addition to the growth rate we discussed earlier, what are some of your other takeaways from this study?
I think in the interest rate environment right now, having an alternative to a traditional long only or long short fund is really what these funds do. Even if you accept the fact that maybe the returns are similar over an entire investment cycle, you're doing it in different ways and different manners. And I think it goes back to the kind of diversification that we always say, look, diversification is part of the problem. We don't think it's the ultimate solution. That's why we use options in our solutions and our strategies to really be able to manage that market risk. But I think overall, having a different group of strategies that can actually perform in different types of market environments is what the whole concept of creating a portfolio. The game for advisors is to create a portfolio that will smooth out the returns and give them consistent returns over time.
Yeah, I would love to see a follow-up, a corollary to this study, kind of hitting on that point you mentioned there, Randy, of really perhaps parsing out the more hedging, defensive-oriented strategies versus some of the more income generation, a little bit more speculative type strategies, and kind of parse it a little bit further. I know you're kind of splitting the sample size down into even smaller numbers at that point, but still, it's a small universe to begin with. But not all options-oriented strategies are created equal. Someone who's just blasting out at-the-money straddles is a heck of a lot different than someone who's constructing overlays and things like that. So I'd love to see how these numbers break down on a more risk management type basis, looking at the funds that do provide that sort of risk management, because a lot of the funds out there that use options, they prided themselves on having a pretty decent year compared to the market. Even in years like 2008, their drawdowns were certainly dramatically less than the broad market, and certainly less than the numbers here quoted in this study. A couple other factors here worth noting in this study. In addition, if you want to check it out, like I said, I mentioned the URL, the title for this. It's available, linked at our website, theoptionsinsider.com. You can also, of course, find it, surf on over to the SIBO and click on their research. A lot of other places will be linking to this study as well. And there's a lot of data in there, too, that pertains specifically to CBOE proprietary products. I didn't get into that. Some interesting stuff like how much premium they're collecting on products like the BXM every month, which is a buy right index, and things like that. You can probably skip past a lot of that unless you're very specifically interested in the SIBO products and really focus on their take on the industry as a whole. That's really what attracts us here, and what I think is very interesting for us here. One notion I did find kind of interesting, speaking of notions, the notional value of the amount of volume that is going up some of these products. A lot of our listeners like to use big institutional-oriented products to hedge their portfolios, like the S&P 500. If you're trading SPX options, may interest you to note that in 2014, the average daily volume in the SPX options translated into a notional value of $172 billion. That's billion with a B every day, going up in that SPX pit. So if you're out there saying, hey, I need somewhere with a little bit more bang for my buck to kind of hedge my products out there, and SPY is not doing it for me, SPX may be an interesting option for you, pun intended. So a lot of interesting data out here. I encourage you guys really to dive into it. Again, it was 80 options-based funds that they conducted the study on, a total of 119 that they analyzed, but they took out 39 because they found that those didn't particularly pertain to their broad categorization of comparing to the S&P 500. They have some income ones here. They have some CTA type products here and a bunch of other things in the analysis. But again, check it out. 80 funds, including our friends over there at Swan and their Swan Defined Risk Class 1 here. SDRIX is the ticker symbol if you want to check that out. So interesting stuff. I encourage you guys to check out this study, because it isn't often we have a hard data on this space. And if you're looking at clients, or your clients giving you any pushback about utilizing options in your portfolios, here's some great data to show them and say, hey, actually, I'm not adding risk to the overall equation. I'm reducing risk, and that's what we're all about here at the end of the day on the advisor's option. So I wanted to bring that up. We're going to get a chance to dive into some hard data. Again, I encourage you guys to check it out for yourself. Now we're going to turn the tables over for you guys and give you guys a chance to participate here and talk a little bit about some your listener comments, your listener questions, and open up the old listener mailbag.
Listener mail. Listeners write in. Mailbox.
All right, as always, we got a bunch of great questions lining up the old mailbag. You guys really take advantage of that, and we love to have you guys do it. Of course, you can send us questions by surfing on over to theoptionsinsider.com. Click on the comment on the show notes there, or use the website feedback form. A lot of ways to get in touch with us there. Find us on email, questions@theoptionsinsider.com. Find us on social media, twitter.com/options, facebook.com/theoptionsinsider, or, of course, use it all in the mobile app. It's all baked in there for you. First question comes from Alpha Numero. I like that handle. This is the good one for you, Randy. You're in the overlay space. Uncle Mike, this will interest you as well. Of course, you do a lot of hedging of the S&P 500. They write, happy 2015. It seems like we're looking somewhat top-heavy in the broad indices these days. I typically run portfolios as long equity, usually SPY, with an out-of-the-money 1 to 2 month covered call, typically around 2.5% to 3% out of the money. I often pair that with a farther 2 to 3 month out-of-the-money put, typically 5% out of the money. In the current market, would you recommend tightening up on that put, perhaps to around 2% out of the money? This will undoubtedly result in a debit, but I'm okay with that if it preserves my portfolios. Would you also recommend tightening the covered call strike to reduce the net outlay on the position? What other strategies would you recommend for practitioners like myself who want to remain in the market but are concerned about near-term risk? That is pretty much our mantra here on this program. You want to stay in the market, but you're concerned about risk. What do? That's kind of the ideal use case for options. So Alpha Numero, thanks for writing in. Great question. This is kind of right in our wheelhouse. And speaking of wheelhouses, Randy, this is clearly right in yours, because this is what you guys do on a day-in, day-out basis over there constructing your overlays. So what advice would you have for our friend Mr. or perhaps Mrs. Alpha Numero who wants to maybe tighten up their collars a little bit here?
Well, I think the first thing I would say is it just depends on the philosophy and strategy you're trying to implement. It sounds good to say, hey, let's tighten up on the downside and maybe bring in the call to get a little more premium. That obviously can benefit if there's a down market, but I think you're entering the realm of more of a market timing perspective if you're going to strategically or tactically change back and forth between how long you want to hedge, or maybe the distance between the strike price and the current market on the call and put side. So it just depends on what your view is and your long-term view of how you're trying to ultimately generate value to the portfolio. We've talked about this many times on the program. One of the other strategies you can employ is maybe doing a put spread as opposed to just buying a put. That obviously doesn't give you as much downside, but if you're willing to be a little more active on rolling those short puts down, if the market does move down substantially to make those puts in the money, then I think that's another strategy that Swan have been implementing since the beginning of our existence. So we think that's a pretty compelling argument to take advantage of the volatility skew, as well as just trying to collect some premium when it's available. But I think it just goes back to whether or not you feel comfortable about timing the market. Just acknowledge that's what you're trying to do at this point, and if you're okay with that, then I think it's a good strategy.
Mike, you clearly spend a lot of your day over there at RCM hedging the market and then finding ways to pay for those hedges. So what would you have to say for our friend here, Mr. or Mrs. Alpha Numero?
I would say to Mr. or Mrs. Alpha Numero, first off, I like the name as well. I think that's pretty cool. I wish I'd have thought of that. But second, I think that another way with which you could do it in terms of how you would set it up, I would lean more towards tightening the call if I had a choice between the two of them. In terms of tightening the put or tightening the call, I would tighten the call at this point if you are bearish on the marketplace or just kind of concerned about the marketplace. And the reason is let's say that we come down, market comes down, you can continue to roll the call down as the market comes down. And oftentimes, let's just say, and this is totally theoretical, the market just goes down 20 points a day in the S&P, and as it goes down, you keep rolling down your covered calls. Volatility is going to come up. Theoretically, it may not. Of course, it's a separate entity. It's a separate Greek, but a lot of times it does. And so as you're rolling down, you'll get more of an opportunity to sell covered calls at a greater price coming down, and your put will come up as well because the volatility, in theory, is coming up. With that being said, the other thing with which you could do as you're setting that up, maybe you could perhaps go out a little bit further on your covered call if you wanted to. Because of the fact that it's a collar, there would be no margin issue against, and I'm just overemphasizing this, I'm not recommending a specific time frame, but let's say you had a 2-month put and then you sold a 6-month covered call. You could do that as well. Now, granted, I know what you're thinking, maybe the 2-month put, that's not time decay efficient, but if you're looking for a little bit of extra juice to the downside, that's another way with which to go. So hopefully that helps, Mr. Numero, or Mrs. Numero.
Great question, Mr. or Mrs. Numero. Thanks for writing in. All right, next up, we have a question from RVC10. They write, are there any special tax considerations I should consider before using options on behalf of my clients? Another good question. We touched on this in the past. We've often talked about maybe having a special tax-oriented episode of the program because it is such a big talking point, a big issue for so many advisors out there. It really does dictate what strategies they can and cannot use. So it might be worth us really diving deep into that. But we have touched on some of the salient aspects of that area in the past. In particular, 60-40 tax treatment, one of the really biggest tax considerations you have to think about when determining which options product you may want to use. Uncle Mike, I know you deal with this on a regular basis over there at RCM. Why don't you go ahead and outline 60-40 tax treatment to our friend here, RVC10, as well as which products that actually applies to?
I'll even do you one better. I'll go through 60-40 tax treatment, and I'll tell you about some of the other tax strategies that I like to use with options.
A double whammy today.
Oh, it's just an exciting day. I don't see how life could possibly get any better. Step one, 1256 contracts or 60-40 tax treatment. Let's say that I bought a call option on Google for $100 and I sold a call option on Google for $100 a month later for $200, $100 profit. If it's on Google, I'm going to have to pay short-term taxes on the entire $100 profit. Now, let's say that I do the exact same thing with SPX. I buy a call option for $100. You're going to have to go pretty out of the money to get a call option for $100 on SPX, but work with me here. And a month later, I sell that same call option for $200 on SPX. Well, if it's on SPX, then I would have to pay the long-term rate on $60 and the short-term rate on $40. It's something known as 60-40 tax treatment because the SPX is what is known as a 1256 contract. So on there can be some advantages to trading 1256 contracts. And it's not only the SPX, but it's a lot of other contracts as well. For a list of them, you can go to the CBOE website, and it also applies to futures contracts and futures options as well. So that's one thing to consider when doing something like this when working with options with clients. I do a lot of things based upon SPY, the S&P in general, a few individual issues. But the other thing that I'd like to mention about the 1256 contract is that if the option is in an IRA, then it really doesn't matter. And that's kind of where a lot of my strategies come in because a lot of my clients have money in an IRA. So what I like to do is, this is an oversimplified example that I like to use. Let's say that you have a client that has, and I'm just making up a number here, $20,000 in an IRA, $80,000 in non-qualified money. And let's say that you determine that his risk reward, and I'm oversimplifying this to the nth degree, I understand that, but hopefully you'll get the concept. Let's say that you're not an option guy, and normally you would want to have 50% exposure in stocks, 50% exposure in bonds. Well, you could make the case of whether you should put the bonds in the IRA because the income paid on the bonds, then you don't have to worry about taxes on it, and only 30% of the bonds outside the IRA, and then the stocks, all you got to worry about is capital gains as opposed to income tax. You can make a lot of cases for it. What I like about a tax consideration with options is you can use that IRA, create the portfolio to where you leverage the stock within the IRA using options. Now, when doing so, you're going to have to buy call options. And I know you're thinking, well, Mike, you got to pay premium for those. Well, you do. And yes, it is a decaying asset, so you'd have to manage that time decay risk by selling some spreads, selling some other calls against it, a variety of things. But you can create a portfolio that has the equivalent stock exposure of $50,000 right there in the IRA. And with the remaining $80,000, instead of using bonds, maybe use muni bonds, use cash value life insurance, use some type of a tax efficient vehicle to give you the ability to have the tax advantage with the entire $100,000 as opposed to just the $20,000 in the IRA. So those are two ways with which I like to look at taxes when working with options, and hopefully that helps.
All right. Thank you for that, Mr. Uncle Mike Tusaw. And of course, Randy, you guys deal with this a lot over there at Swan as well. What do you have to say for our friend here, Mr. and Mrs. RBC 10, when it comes to options and taxes?
I prefer the 1256 contracts, obviously, for the tax treatments that we already talked about, that you get 60% long-term treatment, 40% short-term, regardless of holding period. It's also important to note that I would also say that you have to mark to market the gains if you hold over a contract into the next year or from the prior year. So that's an important consideration. But everything else being equal, another reason why I like the 1256 contracts is those markets are typically pretty liquid and pretty deep. So the stuff that we do at Swan, it's important that we have markets that are very liquid. So SPX, RUT, VIX, stuff like that. It's beneficial, I think, over the traditional option contract.
Yeah, look at that, 172 billion a day in notional value going up in the SPX. That's certainly pretty sizable, however you want to cut it. And I'm glad you brought up the topic of liquidity, because that plays right into our next question here. This comes from a listener, goes by the handle Solus. Maybe that's their name. I'm not sure. Solas. I'm not sure if I'm pronouncing that correctly. They write, much talk lately about the lack of liquidity in big institutional products like SPX, thanks to Dodd-Frank and big banks cutting desks left and right. The folks at Swan certainly qualify as institutional customers. Have they noticed any degradation of liquidity over the past year or difficulty getting their trades done? Thanks. This is an interesting question, a very timely one. This has kind of become the talk of the town in a lot of options and derivative circles over the past few months. I was at the Global Derivatives Conference here in Chicago back in November. This was certainly a hot topic of conversation there. Of course, when the markets really started to get a little bit more rowdy towards the end of last year, particularly into the October timeframe, when we saw the vol in products starting to really increase dramatically, that was when a lot of people started to speculate maybe perhaps these pockets of some of these big institutional products where the desks had been stripped or forced to shut down and move out in some big products at some big banks. Maybe that was starting to be seen in the products themselves, and whether that was actually exacerbating what we were seeing from a volatility and from an underlying movement in products like VIX and, of course, SPX and others like that. Randy, you guys are out there working as customers every day in these products. What would you have to say to people out there who are scratching their heads about that? Are you starting to see these displaying an impact in products like the S, or do you think it's still just as deep and liquid as it ever was?
Well, I would start off by saying we get asked this question not about the specific Dodd-Frank, but at the more general question of what kind of capacity we have using the strategies that we do, and we always come back to the same thing and kind of smile and say, no, these markets are extremely liquid and deep, and therefore they've been able to handle the trades and the execution the way we wanted to be able to do it. What is that real number? When is it going to start mattering? If we use your $172 billion number in the previous segment, then I think we got a lot of room to grow. And of course, I would argue that the options market is continuously growing at this point. And, the higher volatility, I expect to even see greater gains in the future. I think so. There's obviously a lot when the markets are moving a lot. You're going to expect a lot more trading activity and volume. So I don't know if I attribute it to anything in Dodd-Frank. I'd say more the volatility in the market and kind of the one-way market. It seems like it's been over the last year with several pullbacks of maybe 5+%. Really, quite frankly, doesn't qualify as a big pullback in my mind. So I haven't noticed that at all. Someday we'll see if we get to that level. I think we manage something short of $2 billion at Swan, so at that level we're not seeing any type of issues come up.
So you're not out there having to work orders any longer, or having to pay through offers or anything like that to get your trades done. You haven't noticed any of those kinds of impacts.
Nope, not at all.
And you see things out there like products like VVIX. So I use product in quotes. So a disseminated item like VVIX, which is, of course, the volatility of VIX, gapping up crazily over the past few months, seeing it gap well into north of its normal range out there into the 120 range and beyond. That doesn't maybe make you scratch your head and say maybe something's at work out there from an overall structural perspective in the market. I think it's kind of just an aberration driven by what we saw, those kind of, like you mentioned, those kind of more maybe somewhat aberrant sell-offs we saw in October and in December.
See, I don't attribute any of that stuff to something really special out there. I would argue that the market's probably returning to more normal levels of volatility long term. We've had, it seemed like in 2013, maybe in the start of 2012, 13, and 14 of relatively low volatility levels. So no, I don't see anything that special.
Well, there you go, Mr. and Mrs. Solis. So far, at least, not seeing much in the way of impact. Still able to get their trades done in a big, deep product like SPX, which is still pretty deep and liquid if those numbers are to be believed, and they probably are pretty accurate out there. $172 billion with a B going up notionally, at least, in the SPX. That's a serious amount to bite off. Take a lot to really move the needle out there from a liquidity perspective. Moving on to another question we have here. This comes from John D. He writes, can you please explain the concept of risk premium as it implies, I think he meant as it applies, a little bit of a typo here, to options trading and hedging? It's an interesting question. This term risk premium has a lot of different definitions. It's bandied about out there in a lot of different ways. The way it's typically used in the options world is typically to apply to the amount of a premium you're paying for the implied volatility in a product versus what's actually being exhibited in the marketplace. And you could break that down a lot of different ways. You could look at, let's say, the 30-day implied volatility of a product versus the 10-day realized or actual volatility of a product, or maybe the 30-day implied volatility versus the 30-day historical or realized volatility of a product. Some people will try to take that historical volatility and extrapolate forth some sort of expected value for the future and then compare that to the implied volatility. So a lot of different ways you can break down that term, the risk premium. But what it typically applies to at the end of the day is the implied volatility levels in the marketplace. Of course, the actual volatility levels that are being implied, as the name suggests, from the prices in the marketplace are typically, all things being held equal, all things considered, going to be higher than the actual volatility that is exhibited in the marketplace. This is kind of a fundamental characteristic of options, and that comes around for a variety of reasons. You have to, of course, implied volatility is a guesstimate. It's the market's guesstimate of what's going to happen going forward, so there's going to be a little bit of a fudge factor built in there. It's never going to be exactly equal or lower than the realized. So typically, all things being equal, implied volatility is going to be higher than realized. How much higher? That's when you get into measuring what that risk premium is. If it's dramatically, demonstrably, significantly higher than what's realized volatility being exhibited in the marketplace, well, maybe you want to consider maybe selling options in that scenario, and vice versa. If all of a sudden you have these moments, and they do happen, when realized vol spikes above implied volatility, you may want to consider being a buyer of options in those scenarios. Some good tools to help you identify where you fall on that spectrum are a very basic tool called volatility cones. You can lay those out for pretty much whatever underlying you want. Different brokerage platforms will generate them for you. You can search for volatility cones anywhere on Google, and you can find these products or these tools that will calculate this for you. And that will show you where the volatility mean is, as well as where you fall one standard deviation above or below and two standard deviations above or below. It's kind of like a Bollinger Band, essentially, for volatility. And if you look at that tool, that will show you where your current levels of implied volatility fall on that spectrum versus realized and versus just general historical implied volatility. And that will allow you to see, well, wait a minute, I'm actually, right now, we're trading at about an implied volatility level that is about two standard deviations above the mean. Maybe I want to consider perhaps not buying at this level and things like that. So there are a lot of very simple, very basic tools that will help you determine that and maybe how that will impact you. But the basic concept is essentially how much is implied vol over realized vol, and in terms how great that discrepancy is will usually dictate what types of strategies you want to employ. Randy, anything to add here for our friend Mr. John D, who wants to know about the risk premium out there in the marketplace?
Well, I think you did a great job of explaining the basic concept. Maybe not the $1 million question, maybe it's the $1 billion question is, how can you take advantage of that in the marketplace? I'm always a little skeptical about people's thinking they know what's going to happen or timing the market or taking advantage of whatever perceived opportunity they have at that time. Obviously, on some small circumstances, you can absolutely do that. Systematically, can you do that over, let's say a longer periods of time of not only years, but maybe decades? I mean, I think fundamentally it's one of the basic reasons why we think that we should be selling short-term premium on a consistent basis to take advantage of that. Obviously, I think that's not the only solution, just to count on this differential that may exist at a particular period of time or over time. You obviously have to weigh into risk management tools that you're going to do to minimize losses when you sell premium, when you perceive it to be advantageous for you to actually sell that premium. Those are the kind of things that you have to take into account. But generally speaking, I don't know exactly what that number is, but I definitely think it exists.
Yeah, it varies. I've seen different historical studies showing what that number is. I think right now it's depending on how you look at it. If you look at SPX 30 days versus realized, or look at SPX 30 day implied versus mixed cash, it's somewhere around either a 1 to around a 3 or something along those range. So 3 points. So it depends on what products you look at and how you break it down. But that's a good point you raised too about the notion. I think it's kind of overused a bit that volatility is mean reverting. Volatility is mean reverting. That is true in the long term. I think that gets kind of overplayed a bit in the near term, and you see places like the SIBO and others when the VIX cash was hovering around the 12 range earlier in 2014, really beating the drum for volatility as mean reverting, and it has to gap back up to its 19 or 20 long-term average. And so we see a lot of people falling into that trap and maybe perhaps expecting volatility to mean revert aggressively, and the truth is it could languish in any part of the curve for an extended period of time. And so the question is not only is it mean reverting, but when will that mean reversion occur? So when people are looking at volatility, thinking of it as some sort of mean reverting asset, that is indeed correct. But when you're looking at things like volatility cones and risk premiums, make sure you also take into consideration the fact that just because you're 2 standard deviations above the mean when it comes to volatility doesn't mean it's going to revert tomorrow back to the mean. It could take weeks, months, or even years, depending on the product. So a lot of people have had problems and gone broke underestimating the lack of speed sometimes at which volatility is mean reverting. So that's a bit of an interesting prospect and certainly one to consider. But a good question, John, and certainly probably an interesting one we could dive into. If you like that topic, I encourage you to also check out our Volatility Views program. We get into topics like that, implied versus realized, on a much more granular level there on the Volatility Views program. Got time for a few more questions here. Let's see, what do we have here? We have a question here this is a related question here. This comes from JPK211. They write, on several of your programs, you mention that it is important to understand the VIX cash level at a given SPX level. Can you please explain this further? A lot of good volatility questions coming in today, Randy. This is an interesting one. This kind of goes back to a concept we talked about on this program as well as others on the network, the notion of volatility having a context. When you see numbers bandied about like the VIX cash, I tell you right now today, the VIX cash is printing at 20.21. What does that mean? What does that tell you? And by itself, not a heck of a lot, really. I mean, it might tell you that overall volatility may be a little bit elevated in the S&P 500 compared to some historical measures. But without that context to it, it really doesn't mean a whole heck of a lot. That's why we always try to mention also levels like where the S&P 500 is trading right now. Right now, it's about 2018 in the SPX cash or the S&P cash out there. So when you look at those levels, that gives you a little bit more of a context. An VIX level of 20 when the S&P is down at, let's say, a 1500 level is a different beast. Remember, we talked about implied volatility skew on this program before. And in general, as the underlying and most equity and index options decreases, that level of implied volatility is going to increase as you get into that put wing. So if we were to drop right now from 2018 down to 1500 or so, you might expect the volatility to increase a little bit. So if we were trading at, let's say, a 20 down there, it wouldn't be relatively considered that elevated because you probably would expect that sort of increase down there. And that gives you that context. Whereas right now, a VIX cash in the 20 handle with the S&P considerably high is actually something interesting because it's not perhaps what you would expect, and it's indicative of a lot of other things perhaps at work in the marketplace. Clearly, we've gapped up fairly aggressively and had a little bit of volatility of late, so that's playing into that number. Of course, you also saw some very odd macro events like the Swiss franc really starting to play into the market. So that's added some volatility to the broad equity space. And all of these things are starting to contribute to the overall level of implied volatility being a little bit inflated compared to what you might actually expect on this point of the volatility skew curve here in the S&P 500. And that's what we really mean by having a context for an SPX. In general, volatility in equities and indexes should decrease as the underlying increases. There are portions and times when that isn't the case, certainly, but that's in general. And the volatility should increase as the underlying decreases. And so that's what we're talking about with context. You really want to know not only where you are from a VIX cash levels, gives you kind of the at-the-money S&P 500 implied volatility for 30 days, plus or minus a few other factors that are thrown into that equation. Or you want to also know where you are. So that gives you, of course, one more time, that gives you a starting point for where you're looking at it in terms of where you are on a broad volatility level. Then you can also look at those tools you talked about, volatility cones, as well as where you are on that strike price chart. Are you high on the strike price chart? Are you low on the strike price chart? All those things kind of combined can help give you a much better context for what's going on in the broad marketplace. So just looking at the VIX cash by itself, as it's bandied about quite a bit, isn't the most informative measure in and of itself. There's a lot more that goes into giving that number some meaning, and that is indeed the context of what's going on in the marketplace. Randy, you guys obviously very active out there in the S&P 500 options. You do volatility, obviously being a big concept for you guys and a big concern on a daily basis. What would you have to say to our friend here, JPK, who wants to know about a little bit more about the context of VIX and volatility?
Well, I think you should always be aware of your surroundings and like you said, where the VIX is relative to historic norms, but realizing that what is low can stay low and go lower, and what is high can stay high or go higher. So it gets back to the fundamental premise: can you do something with that knowledge consistently and generate profits over time? And so that's where I kind of come back to, the value of what you can actually extract from that kind of analysis that you want to do. One of the things that I would just point out as it relates to Swan is that because we're committed to hedging our portfolios pretty much on a consistent basis, that we always have some put protection in place, we're somewhat more committed, obviously, to be selling premium, even in times where we perceive volatility to be lower than normal and maybe mean reverting or not in the short term, just because of the combined exposure of our long and short positions really almost dictate that we be somewhat agnostic as to making predictions. And so that's my kind of angle on the whole approach. Some people may have a more aggressive approach on taking advantage of perceived undervaluation or overvaluation of the volatility index at a given point in time.
All right, great questions, everybody. That's all the time we have for the mailbag for this episode. But before we go, let's dive into a really quick Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, welcome to the Tricks of the Trade segment. This is where we break down some interesting topic a little bit further here in the world of options and tell you how we utilize it, how we may apply it, or in some cases we may not. And that's kind of what we're getting at here with this month's Tricks of the Trade. All these questions coming in about volatility, short-term, long-term, things like that. Got us interested in a lot of other products that are going on out there, some that have caught fire in the volatility landscape and others that haven't. And it's kind of interesting if you've been paying attention to options at all over the better part of the last year, certainly the last couple of years. The broad trend in most options products has been migrating towards short duration. Weeklies are all the rage. People want to just sell weeklies all day long. It's kind of the hottest product category out there. Most big products out there are creating some sort of short duration product to go along with that, to really feed that trend. So when we saw last April that they were creating a short-term VIX product to kind of highlight the growth and interest in weeklies, because even on a big institutional products like SPX, roughly a third of that volume is now going up in the weeklies out there. So that's a ton of paper that's very, very focused on short duration contracts. And so it seemed like the combination of the interest in weeklies, in addition to all of the love that products like VIX get, seemed to be a no-brainer. This product called VXST, which is a short-term volatility, short-term VIX product, was going to be a home run. And yet it seems like looking back on it, 2014 and 2015, it really hasn't been. In fact, on days, and like we've seen early 2015 here, where the market's been moving 1% or close to it on some days, and big products like SPX and VIX are doing close to 1 million contracts a day, and they're lighting up the tape. There's days when this product has done 0 contracts. It really has failed to catch fire. That's why I wanted to bring it up on this show, Randy, to kind of pick your brain about it a little bit, because one of the questions we hear a lot from the practitioners on that end is they created this thing, but I don't know if anyone really was asking for a product like this. And it certainly seems that, given the volume numbers, that may indeed be a common concern with a lot of people out there, that they created a product really in need of a market. I know you mentioned you like to trade a lot and take advantage of the short-term premium from a selling perspective. Randy, are you cognizant of this product? Does it interest you at all? Is it something you guys would ever utilize over there at Swan? And then B, have you guys seen the growth in things like short duration weeklies in the SPX? And has that really attracted you to that side of the curve? And have you started looking at more, as a result, at kind of short duration gamma/theta trades to really incorporate into your strategies?
Well, I think my short term is probably a little different than most people. Our short term is usually 1 to 3 months, not in a matter of weeks. You know, as a portfolio managers that manage obviously portions or big percentages of someone's portfolio, we're really more look at ourselves as the kind of strategic long-term portfolio type stuff, not as much as the trading. Now, of course, we use trading in our strategy, but we always have to deal with the second layer of, it's not about what you can actually do and you think you can succeed at, but it's what you can explain to your ultimate client. So getting into those types of conversations is not something that we see an immediate benefit to Swan at, and it's not really the area of the market that we're trying to fit into. So I would say that we're not really interested and I don't have any expectations that we'll be using weeklies anytime in the near future. We potentially could use them as some type of short-term hedging, in addition to the hedging strategies we always employ on a regular basis, but not probably as a trading vehicle to generate supersized profits.
Yeah, it's one of these products that's kind of been interesting to watch, and just the general growth rate in that area has been interesting to watch as a whole. We have a great write-up about this on the website, theoptionsinsider.com. It's called the Mystery of Short-Term Volatility. If you want to get into this a little bit more, listeners, I encourage you to check that out. But this is a very timely debate that's going on in the space right now, and I know you look at a lot of different products across the spectrum out there, Randy. I want to make sure I got your take on it as well for our listeners, because it is an interesting area. A lot of them might be attracted to a product like this, VXST, because it does combine a lot of those flavors they love, short duration and VIX. It's two great things that taste great together. And yet when they start trading or looking at it, they may be surprised the actual volume that's going up in a product like that. So I encourage you, if you're interested in that, listeners, check out some of our other programs on the network, read that article, or indeed write into us here on the old program. We'd love to get into it further. But unfortunately, that's all the time we have for the Tricks of the Trade segments. Also all the time we have for this episode of the Advisor's Option. But before we go, as always, I'm going to check in with each of my cohorts, my partners in crime, to see what they have cooking at their respective areas that may interest you. We'll start off with you, Mr. Mike Tusaw. What's coming on the pike over there in the land of RCM Wealth Advisors?
Yeah, if anyone is interested in learning more about RCM, feel free to come to our website, rcmwealthmanagement.com. Got a lot of exciting things going on.
All right, thank you for that. And of course, last but not least, a lot of things cooking over there at Swan these days. Randy, you have the rebrand, you have the impending launch of more funds in the near term. I'm not sure we have enough time to get into all of it, but give us the rundown on all the latest happenings and developments and what's coming on the pike over there in the land of Swan Global Investments.
Well, this will be a very short segment. We did launch our Swan Emerging Markets Fund based on the same defined risk strategies, our flagship fund and strategy. We're pretty excited about that, launching that. We've obviously have a track record and have a concept that we can apply to different assets. So we're pretty excited about going forward. That's really the main thing that's new at Swan. In terms of product launch, we have grown the firm a lot. I think last August, we were at 10 individuals. Now we're at 21. So we're pretty excited about the growth that's gone on, and look forward to launching new products in the near future.
Yeah, I'm looking forward to seeing more Swan products, including in whatever version 2 of this study comes out in the near future, seeing more Swan products included. Get that number up beyond 119, at least a nice even 120, and then we could go from there. But of course, listeners, check out all of that and more. Just going over to swanglobalinvestments.com. You can find all that information for yourself, all the strategies, all the products, all the outlines, all the things they have going on over there. Lots of good stuff. Check it out, Swan Global Investments, to learn more. And on behalf of Randy and Mike, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.